What's up, everyone? Welcome to Somehow Stocks. Somehow we trade and somehow we win. Somehow. If you're here, you care about growing your money. You actually want to trade with intention and understand the market, not just hype. I've been trading since I was 16 years old. Hello, my name is Devin Mistry, and I started in simulated markets, just learning how price action moves. And over the years, I've gone through it all. You name it, the crypto surge, meme coins, NFTs, the GameStop and AMC craziness, and to just recently, the beyond short squeeze. I mean, that's one for the history books. But for the past 9 years, I've really drilled into the analytics and fundamentals, RSI, PE ratios, macro indicators, and these aren't buzzwords. They're signals. And when you understand them, you stop guessing and really start trading with purpose. And I can be an example firsthand of taking losses. I'm not afraid to say that I am a loser. I've taken many losses, but hey, I've had wins too. And every trade taught me something. And that's why this channel exists. Somehow, stocks isn't about pretending we know everything, it's about showing up, learning, applying, and growing together with real intentional traders. Over the past year, I've leaned into options trading. And let me be real, options can humble you fast. One day you're up, next day you're down before lunch. But once you start mastering the Greeks and you build discipline, re strategize, set up your stop losses, it becomes strategy, not luck. This will not be financial advice. This is just me sharing my experience, lessons that I've learned the hard way. And if you stick around, we'll go through wins and the losses so you can skip some of the pain I had to learn through. Because let's face it, there's enough fear out there. Everywhere you turn, someone's yelling, the economy's collapsing or the next crash is here. But here's the truth: long term, the market always recovers. And the real question is, are you disciplined enough to stay in the game? Any long term investor will tell you it's not luck. It's about buying the dips, setting your stop losses, and taking profits when it's time. You'll not catch the tippity top at every time, but consistency beats perfection every single time. So, what's actually going on in the economy right now? And is it even a good time to be investing? There are a lot of moving parts: tariffs and tension between China and America, the upcoming or maybe delayed meeting between Donald Trump and Xi Jinping, interest rates set to drop this Friday, and quantum stocks finally cooling down from their run. I've been following RGTI, QUBT, IONQ, among others. And then we have the infamous, of course, AI bubble, who has been just penetrating the market and affecting so many stocks. We think of AMD, NVIDIA, the powerhouse that's leading all chips with Taiwan's semiconductor. We have Microsoft, ASML, and then SoundHound AI, Big Bear AI. There's just so much stocks making deals with OpenAI, and Sam Altman's got his hands on almost every other company and investing in them. So if OpenAI fails, every other major company fails with them. So it's almost impossible for them to fail. He's been backed up by every major company. So this AI race has turned into something beyond our imagination, and it's truly just beginning. And then we have energy and tech earnings hitting across the board just this week. For example, Tesla missing earnings, and we see their stock down about 4% in after hours. Alcoa met expectations, which is helping them recover in after hours. Netflix missed yesterday, which has brought them down 10%. And there has just been so many big names releasing earnings this week. And this doesn't just affect these individual stocks, but it ripples into the greater market. If we look at the SPY right now, that's also been down 0.5% today, which is, a pretty big dip when looking at the SPY, and especially with this bull market that we've been on. Now, let's take a second to talk about gold. Yes, gold has been on an absolute heater these past few months. When we're looking at the 3 months chart, we're up over 20% just these past couple of days ago. And in the past week on October 21st, we saw a big dip. And this was to be expected. If you've been following me, I've been saying that historically, we've never seen gold go on a 10-week span of green. So this was really nice to see a pullback finally from gold. Now, in the long term, gold isn't going anywhere. It's going to continue going up. But if you wanted to play this to the downside in the short term, it could relatively be lucrative. But again, it's quite volatile. I'd say you want to look in your ranges between 375 and 360 for resistant marks. If we're testing below 360, we might see a greater dip. However, in the long term, why is gold acting this way? That's the question we need to be asking ourselves. And I can tell you why. And this might change your mind if you haven't heard the deeper picture already. So there's a reason China has been stockpiling gold in its reserves while the dominance of the US dollar has been showing its cracks. So a major moment was when the US froze Bank of Russia's treasury bills after the invasion of Ukraine in 2022. And this was hundreds of billions of dollars. And essentially, this made other countries ask, how safe are US assets really? And that's when countries started to take their money out of US Treasury bills because they thought, what happens if we're next on the bad side or we're next on that list? So we're seeing diversification away from US treasuries and toward tangible assets like rare earth materials and gold. There's even talk that China might link their currency more directly to gold, so money is backed by something finite and real. And that shift is big. It'll ripple through global markets. We've seen China actually being the number one stockpilers of gold, right? And why is this happening? They say they have up to 3.6 tons estimated gold in their reserves, but analysts are saying this is way higher, way above 5 tons, because this is not even accounting for their state-owned gold in all of those banks and whatnot. So it's crazy, honestly. And do your own research on the gold in Shanghai and in China. It's absolutely absurd. Okay, now let's jump into some stocks that are on my watch list heading into tomorrow. Number one, we have ticker OKLO. This one's an advanced nuclear reactor tech. They just had their reactor design criteria accepted for review by the US Regulatory Commission. On the flip side, this is a company that has no real revenue yet, and they still need huge funding. So it is a high risk, high potential play out. But when we're looking at this stock, it has been one that has gotten major hype on the year and in the past 3 months. We're talking 430 plus returns in this past year. And I do think we're about to hit a major resistance wall in this 1 month scale. You see, we're testing back down to the lows of 114, 113, and this held to be a good resistance at 109, 10 previously. So I do think that this could be a good bouncing point for OKLO. However, if we do start to break past down that 111 range, I would be a little bit concerned about if this goes even further to the downside. This is definitely one that's gonna be on my radar for tomorrow, because if it can break this range of 122 to 123, I do think that this is going to be serving as a nice play if you do options for the upside in the short term. Now, in the long term, I am not too confident on putting my full bets or hedging OKLO. So that is my analysis on Oklo. Let's get into the next ticker here. Okay, guys, the next stock we have on our watch list is ticker HIMS, HIMS. HIMS is a growth telehealth wellness brand. I'm sure you guys heard of HIMS. It's been one of the more volatile stocks in these past few months. And the most significant recent news is actually coming from the HERS side of the business, where they have a new platform in launch for the specialty dedicated to menopause care. And this expansion was just announced again mid October. And the broader strategy is to grow its women's health offerings. When we're looking at hymns, honestly, we're getting a lot of choppiness, lots of highs, lots of lows. But the ranges we should be watching for hymns is if it drops below the 47.2 range, and if it can tap back in above 51, watch it to the upside. If it does fall below 47.2 range and into the 46s, we will want to be watching that to the downside. We don't want it to be sitting in the 46 all days. And if it does, we might see it dip down a little bit more in these next couple of days. Finally, the third ticker on my watch list for tomorrow is OSCR, Oscar Health. This is a health insurance distributor. You've got strong institutional interests, recent fund fillings, but also guidance revisions and regulatory and financial headwinds. So, what am I looking at here at Oscar? Well, in the 1 month chart, you can clearly see that we're picking up on higher lows, which is always a good sign, especially when we're getting a squeeze coming in for a potential breakout. I do see Oscar being a potential breakout candidate. It has been serving really strong over the 3 month range at 50% gains over a year. We're looking at 24%, and this definitely has potential to get back into, all-time highs by the end of the year. I would say that's definitely possible. I don't see it not being possible, and this is something that I am excited for. Now, if you're looking at these plays, the most important thing I can tell you and you can take away from this entire video is to take your profits and set stop losses. So, what do I mean by this is, let me put it into an analogy. If I flip a coin and it lands on heads, you will gain 40% of however much money you give to me. However, if it lands on tails, you're going to lose 30%. Are you going to take that bet? And the answer should be yes. Your answer should always be yes. And the reason is because if I flip that coin 100 times, yes, 50 times it's going to land on tails and you'll lose 30%. But the other 50 times it lands on heads, you're going to be gaining a 10% profit margin. What does this mean in terms of stocks? For example, let's say I bought Oscar in 2022 at $2.82. And once it went up 40%, it would automatically sell. That's a call secured. However, if it went down 30%, it would automatically sell. That is a stop limit. So essentially what I'm saying is risk management. It's all risk management. And any long-term investor will say that if you set your call secures at 40% and you set your stop losses at 30%, over time, if you have convicted plays that you know are going to do well, you're going to win the market. However, you're just maximizing your returns and minimizing your losses. That's all you're doing. And it's going to be unfortunate because At times, you're going to sell right here at the 40%, and stock is going to go all the way up 100 more percent, and you're going to be kicking the can. You're going to be kicking yourself. You're going to be like, oh my God, like, what is going on? And at the end of the day, you can't do anything about that because there's been so many times I wish I had that 30% stop loss, but nope, it went down all the way down when you think it couldn't go down anymore. So at the end of the day, what you can do is learn the hard way, or you can set your stop limits. There's a lot more that we have to dive into. But for now, I want to hear from you guys. What plays are you watching? What trends do you see shaping in the market? Drop it in the comments. Let's talk. Because at the end of the day, this isn't about chasing the next meme stock or gambling on options. It's about learning how to make consistent, informed moves together. Long-term trades equal wealth. Short-term plays equal money. That's how I see it. And we're not here to chase the money. We're here to build wealth, right? Let's get after it. Let's kill it in the market tomorrow. Welcome to Somehow Stocks, everyone. Thank you.